Let's talk to Marc Ostwald. He is a strategist at ADMISI. Very good morning to you, young Mark. Right, let's talk about the US. We've got 4 thought-provoking slides as always. Let's kick off with the first one, the US rate probabilities by meeting. So we're up to number 4, are we?
We are, obviously, we have this signal from the Fed this week that they are going, well, their intention, one would have to say, is to raise rates 4 times in total. So we get another 2 rate hikes and they still have another 3 penciled in for next year. So they've upped basically their forecast for the US economy. They've certainly lowered their forecast for unemployment and they've edged up their CPI forecasts. So it's not really surprising, and when one looks at the gamut of data that we're getting in, for instance, we had those strong retail sales numbers yesterday. We've got the Atlanta Fed GDP now forecast for Q2 running at a rather whopping, stonking 4.8%, and this is rather later stage than sometimes when we've had those high readings before. That's been at the beginning of the quarter. It's been deceptive. So it's not surprising. So the Fed is definitely out on its own there. And the market is, interestingly, taking a rather skeptical view of the Fed's rate trajectory. It doesn't really believe it. There are a lot of people pointing out, well, the US Treasury curve is getting flatter and flatter and flatter, and that's a recession indicator. I would be very loath to make any interpretations about what the US yield curve is telling us about the outlook for the economy. It may have been a good metric in the past, but with more than $14 trillion of central bank liquidity out there, I think it's heavily distorted, so one has to be a little bit careful. But I think it brings us to another point, and that's this. If we move on to this. This is the US 1-year T-bill yield. So it's at 231. So let's just make some comparisons out there. The S&P dividend yield's 180. The US 10-year note yield only picks up a miserable 60 basis points for a lot risk. This is basically almost risk-free assets, 1-year T-bills. The Canadian 10-year yield's just 227, so below. So why would you want Canada? 10-year Bund yield's 0.42. Thank you, but no. 10-year gilt yield's 1.47. Italy, thanks to the recent debacle, down to 272, but that's not exactly a huge premium over everything. So the point here is it's bifurcated. I would say that obviously the scope to allocate more money to cash now is obviously rising. In fact, the very simplest message about what the Fed's done and what's being done elsewhere is with each rate hike that the Fed does, the opportunity cost of holding cash is falling and falling sharply. And with each rate hike that it does, the opportunity forecast for holding duration, credit, or equities is rising without a shadow of a doubt, though I would want to make the distinction between credit and equities insofar as we've obviously had this big leveraging move, which has been contingent on companies swapping debt, issuing debt, to buy back equities. So the risk is probably greater in credit than it is in equities. More important point is, of course, we look at those comparisons, and then, of course, I thought, well, let's have a look back to 2000 when we had one of our bigger stock market crashes, the dot-com bubble bursting, and see where the S&P dividend yield was back then, and think about where the Fed funds rate was back then, and by extension where the 1-year T-bill was. And actually back then, and it's sort of like now a stark reminder of why we crashed, the S&P dividend yield was sort of in the 1.1 to 1.3 range for about 3 years. So that is a good reminder of what Maynard Keynes said about markets can be irrational. More importantly, at the time, Fed funds rate was between 5 and 6%.
Right.
So the comparison now doesn't look great relative to what we've seen in the past 10 years, but when one looks at it relative to, say, 2000, you would say, well, the equity market could still probably got plenty of mileage in it on that basis. So I think it still advises caution, and one has to remember that back then, people already had a lot of money allocated to cash. They were making the cash work harder because they were allocating money to the equity market and the bond market. Now, they've almost got no cash because it's been pernicious to hold it. Be that as it may, the impact of the Fed rate hikes is obviously being felt most acutely, as we can see in the next chart, in the emerging market space. And that's not really surprising. First of all, the emerging market space has been the space where you've seen the most issuance in dollar terms. They've been borrowing very heavily, above all China, but it's not limited to China. Latin America has been borrowing heavily. And we can see that as much as it may not this rise in US rates may not be having much of an impact on domestic risk assets, international risk assets are now starting to really sort of come under pressure. The yellow line there is the US dollar index. As we can see, it's been appreciating particularly sharply since April. And the emerging market FX index, but that's provided by JP Morgan, has been tumbling as a consequence. So it's not really that surprising that there's a lot of pressure emerging there, and that is going to be our first flashpoint. I think the key point here is if we have a true meltdown in emerging market assets, and I would be wary of that, FX is definitely under the cosh, but we're only back at the levels that we were at the end of 2016, as a reminder. So it's hardly a disaster. If we look at the next chart, which is the JP Morgan Emerging Market Bond Index average yield versus the US Treasury, yes, we've seen some spread widening, but if I look over at the left-hand chart, again, I'm seeing that in context, it's been a sharp rise, but it's not been a disaster. However, the key point here really is if we do see a real meltdown in emerging markets, then there may be a contagion effect to other asset classes, particularly if we get into a situation where, as has been the case on many a previous meltdown, people struggle to sell some of those riskier assets and therefore are forced to sell some of their good assets against it to cover some of their losses. And if you get into a liquidation cycle, and that's really where the threat from the emerging markets side come. Obviously, there are particular flashpoints. Above all, we're concerned about the Chinese debt. Above corporate debt, we're concerned about Turkey. We're concerned, I think we should be probably more concerned about South Africa in the near term. We've got Eskom now closing down the electricity system because they've got no money to pay for resources to drive it. So there are plenty of pressures there, but I still think the key point is this one about liquidation risk if we start to get into real stress. Thus far, I wouldn't call this real stress, just some emerging pressure.
On that note, young Mark, thought-provoking as always. Thank you very much indeed.